All right, where did you put that? Oh, here it is. All right, let me get this up here. All right, we're back here. And here we go. Let me give him a shout. I thought I had the number right here. Where is it? Brian, where's that number? Why am I not seeing the number on? Oh, here. All right, up on the top. I got it. 6, 4, 6, 4, 1, 4. All right. Hey, Jack. This is John Carisco, DayTraderRockStar from Day Trading Radio. How you doing?
I'm doing good.
Thank you for joining us today. I mean, tell you right off the bat that your book is one of the reasons I'm trading, and you probably get that a lot. Your original books.
Yeah, I actually do.
You get that a lot, right? Because that book is written so good, and you know what I'm talking about—the Market Wizard series, the Market Wizard.
Yeah, absolutely. Yeah.
And now you're coming out with your third. Is this really considered part of this? Is this like a series? Would you consider this?
I didn't start it out as a series. I did the first one, and then that was went over so well and was so popular that there were a lot of traders at the time that I didn't include the first one that I thought probably should have been covered. Well, they couldn't all be covered in one book anyway, but it seemed a natural thing to do a second book. So the second book, New Market Wizards, came out I did that only a couple of years after the original Market Wizards, and those were done I did the interviews in '88 for the first one, and then I think about 1990 for the second. So those books are quite a while ago. Then I did another one, Stock Market Wizards, back around 1999, and then the latest one, in which I was trying to really make it more akin to the first two, and that came out just a few weeks ago, a couple of weeks ago.
And that one is the Hedge Fund Wizards. Is that the correct title? What is the correct title?
Yeah. Hedge fund market wizards, right?
Hedge. I recommend your book to all beginner traders because I do a trade and I get that all the time. Well, what books do you recommend for a trader? And there's only a few because, as you know, as someone who writes trading books or market related books, there's so many books out there, and so many books are just a rehash of the same old thing. And something about your books makes it's an enjoyable, exciting read. You don't get that in books. You ask the right questions. You're in a situation which everyone would love to be in. I think that's what's really great about your books is you're in a situation where I wish I could ask this person that question, and you ask the right questions. It's nothing. You ask pretty good questions. And I have to, I give you props for that. They were excellent books, and I always kind of. I actually lent my books out, so I always have to buy your books again.
I appreciate that. Well, actually that was the motivation originally. Was I didn't actually intend to write the book. I had the idea, but I thought it would be a fun idea to do a book where I just go to these traders and try to pick their brain and see what made them different. And it seemed like the book was a good vehicle or excuse to do that. So it was kind of the fun of the project that got me into doing the book in the first place.
So let me ask you some of the questions that I would be dying to ask you because you've actually asked these questions. I mean, were you into trading when you wrote these books? Were you a trader?
Yeah, a little bit. I've never been a full-time trader, and so to go back to the beginning, I started out as a first 2 years as a research analyst. I became research director in the futures area. So I was always like an analyst type, more analytical. But being in the business, I sort of got attracted to trading, and I traded very, very small in those early years. And when I was writing the books, yes, I had my own account. I did trade, and I thought that I could learn something from talking to these people, and it would also make a good subject for a book. So yeah, I don't know if I did it primarily for that. I did it partially because of that.
Okay, because I know now you kind of expanded yourself. You are a co-portfolio manager, right?
Yeah, on the allocation. So I'm on the allocation side in that. I mean, I do have my own little account that I trade, not as a vocation, but just a bit, but not even every day by any means, but just occasionally when I have an idea that I want to do. So I do a little bit of trading, but the fund is a fund of managed accounts, so we're really allocating money to other managers that I've selected.
Now, did all this happen because of your books, all these connections and all these new little adventures that you have? I see that you're partners with the Fortune Group, and you're an advisor to Market Topper. Has this all come about through your...
Yeah, the Fortune, the Fortune Group is a partnership in London. That it was a hedge fund advisory firm, which I joined originally as a consultant, but then became a partner, and the company was acquired a couple of years ago by Close Brothers, so Fortune Group doesn't exist anymore. Oh. So after that, I took a sabbatical to write this book and another book that I finished recently and will come out, I guess, in about a half a year or so. I sought another full-time application, and that's how I ended up with being co-portfolio manager to this ADM fund.
Now, you've mentioned, I wish I had my book in front of me, but you've interviewed the greatest, and I guess as a trader myself, and I know, I guess the key points of your books, with these interviews, is the characteristics of a successful trader, and that's what you come across really trying to get across, and how all these great traders have certain characteristics that kind of are similar to across the board. What would be the, again, and I know you discussed this in the book, but what kind of little gems you could tell us from all those interviews, something that really stands out for a trader today?
Well, it's hard. I mean, I try actually in each of the Market Wizard books I've done, I've always concluded with a chapter where I try to draw the essential points from all the traders. And in every chapter that I do, I also have a conclusion section where I try to give my impressions of what are the lessons, what are the characteristics of that particular trader. So that's a lot of what the book is about. And I can give a few examples, but I would say that the examples are just examples, and they're by no means because there are a lot of different points to it. In this book, I pick up 40 specific, but there's probably more if you go chapter by chapter. But I've taken 4 that I've taken from across the book, 40 from across the book. And just as an example, say the matter of flexibility is a characteristic that I think all really great traders have, and it comes across in many ways, many examples, and people phrase it differently. One trader says, you have to be able to say, I want to go long, I want to buy, I want to sell. You want to just be able to, when things change, you have to be able to change it.
Switch teams very fast. No loyalty, right? And no emotion.
No loyalty, exactly. No loyalty. And there are examples in this book where traders, in fact, one example where traders had this idea, which we can go in if you want to, but it may be tangential. But essentially the point was that he had this idea, and when he researched it in depth, he really figured out that he had it exactly backwards, and he ended up doing the exact opposite of what his initial inclination was, and that ended up being his best trade of the year.
But that seems like that's what you hit right on the thing. So many people say, "Well, I got out right at the bottom, or I bought right at the top," And if they just were to reverse things, it would have been, it's almost like we're programmed to do that somehow. The market has this way about the fear and the greed and how it tips the scale just at the wrong point. Now, we're talking currently, when you're saying you interviewed delays, these are the hedge fund managers.
Yeah. And there's 15 and 14, and to be technically correct, 14 are hedge fund managers, and one was really a prop trader, but he was really interesting, and so he's in the book as well.
Now these are
the title actually was the last thing that came. The title was the very, very last thing, and so it was really difficult because there was Market Wizards and New Market Wizards, so it's kind of hard to come up with another title. But Hedge Fund Market Wizards fit except for this one chapter, and I certainly wasn't going to take it out because of that.
And hedge, back when you first wrote those original books, it wasn't so much as hedge funds weren't in the news as much as they are today. I mean, interviewing the hedge funds,
they weren't even called hedge funds.
No,
they weren't even. The original books were sort of pre-hedge funds. The hedge funds, some of the managers interviewed in those early books, like Bruce Kovner and Paul Tudor Jones, and some of the big names like that. At the time, they were considered CDAs more than not hedge fund managers. So hedge funds sort of came into their own really more. They existed when I did the book, but they were still pretty minor at that point. In fact, some of the major indexes didn't start until the early 90s, and the original book was done in the late 80s.
When you interview a hedge fund manager, I haven't read this book yet, but I will be reading this.
Sure.
When you interview them, it's interesting because, like, again, hedge fund, it's like you could trace this back down back a few years, so it's pretty much a new term, but it's such a visible term. How did these people? Is there? Do you get into how they started their hedge funds?
Oh, always. Well, yeah. I don't really think I'm never interested in the business side of things, so I don't think you'll find hardly anything in the book at all about their operations, their business, how they grew it. I'm not interested in that.
Yeah.
I kind of do what I'm interested in. So the books are all about how they became interested in trading, what their early experiences were, what they learned, how they changed, how they improved, what they do that's right, what they did that was wrong, stuff like that. And has very, the business, the hedge fund business they run is sort of peripheral to it. Of course, it comes up in the context of, hey, this is the fund they run, or the strategy they run, and the questions pertain to that particular investment. But it's not about the investment as a offering or a business structure.
Well, we have many listeners, and I get some of the questions coming in through through Twitter and through the room here. And I want to ask you, one of the people here, Joel, is asking, do you think that high frequency trading in black boxes make it much harder these days compared to when you first originally see the traders and how they came up? Those original group of traders you interviewed, they had some story behind them. It really showed you how their personality traits were really important, being able to manage. Now we have a whole different type of trading style in front of us. Has that play into the part at all? Well,
in the high-frequency trading, I think if you're very short-term, and there's one trader in here who is more of a day trader and trading markets against markets, and he had like his first losing year last year. When I say losing, he lost less than 1%, but it was his first losing year like in 20 years. But he was down, and he's always been up. So he was down, like I say, a fraction of 1%. It's not a big deal. But he did mention that the high frequency trading, in his opinion, was changing a bit how the markets are behaving. But that's part of the way markets are. Markets are always changing in some way, and time and time the theme comes up that you have to change. It comes up in a number of the interviews. I'll give you an interesting example. There's one of the interviews, the longest interview in the book is with Ed Thorp, who's a fascinating guy, and I could talk about him for the whole show, but just a couple of tidbits. He has a phenomenal track record. He ran 2 hedge funds. Just to give you background here, the first hedge fund ran for 19 years, and he had a 19% gross return during that period. But the amazing thing, he only had 3 losing months in 19 years, and all 3 losing months were less than 1%. So he is probably one of the best. Between him and Renaissance, probably the best records that ever been compiled in trading. Now, he was also the originator of a lot of strategies. He was the first one to do stat op, first one to do convert op. He was also the first one to come up with the mathematical formulation equivalent to Black-Scholes, which he didn't publish but used in trading. But getting to the point of adaptation, which I was sort of got into that preamble to answer the question. So how markets change. So he was the first one to do, as far as I know, to do statistical arbitrage. And what they were looking for, all different patterns, and what they found was, hey, here's something that works. If you take the stocks that went up the most in the last 2 weeks and sell them, and then buy the stocks that went down the most in the last 2 weeks, that's a good strategy. And they did that to be delta neutral, and that was the original stat arb. But that sort of started losing a bit of its edge, and then they went to being neutral in each sector, not only being delta neutral, but neutral, doing it separate portfolios for every sector, and they would be neutral in every single sector, and they would do the same basic strategy, and that worked better. And that worked, but that started losing some edge, and the next thing they went to was finding the mathematical factors that were driving the markets. A simple mathematical factor, one of the factors might, there would be different economic variables or whatever they might be, but they didn't do them as specific variables, but that can identify the world, but they did in the mathematical form, which sort of the mathematical vectors that affected the market, and that were not cross-correlated to each other. And so they identified those factors, and then they made the portfolios neutral to the factors, and that worked even better. By the time they went to that iteration, the original strategy, more and more people had been doing stat arb, and the original strategy they started with was barely making any money anymore. But they were still doing stat arb, they were still doing the basic strategy, but they had to evolve. So that's kind of an example. Markets change, particularly because more players come in, and good traders have to adapt to those changes as they occur. You have the same thing with trend following too. It's just changed.
Yeah, that's so interesting because we always talk about a situation with me where I'm dealing with a lot of traders and I'm kind of broadcasting about the markets and stuff, and you notice certain things come into trend and certain techniques work, and even some people have the and you might, I don't know, I was going to ask you if you feel this too, like when you talk to a trader who has a style of trading, is there a hesitation of telling you that style of trading? Is there a tipping point where if it works, a style of trading works, and eventually it doesn't work? Is that because too many people adapted and they're able to, jump the gun on it, or, how is...
Yeah, I mean, certainly that's true to an extent. I mean, for certain arbitrages, of course, once people become aware of them, they don't become, they can't be used anymore. But for any strategy that becomes too popular, that fact alone will impact the strategy. So, say something like trend following. Mm-hmm. Trend following works. It works because there's fundamental reasons why it works. Markets are impacted by fundamentals that have very long-term effects. Part of those are governments. Governments may decide that they want a currency to weaken over a number of years, or governments may want to push stimulus, or they may want to contract an economy, whatever. But once they make those decisions, they can last for a very long time. That's an example of the types of fundamental conditions that can lead to long-term trends. And then you can also have situations simply like if there's a growing demand for something, it can take a while before, say, the commodity, before the supply can adjust to it. And so there are reasons why you can get longer-term trends, and indeed you do have trends. So the fact that there are trends means that there is some potential edge in trend following, and indeed there is. However, back in the early days when I was writing the first Market Wizard book, in those days it was much easier. Trend following was a better return risk strategy. You were able to make a lot more return for the same risk than you can now. And I think because there's so many, there used to be a small amount of money following it. It was just the initial leaders and vanguards, and there wasn't all that much out on it, and people weren't doing it. There weren't a lot of computers doing it. But now when you have hundreds of billions of dollars trading on similar strategies, it does have an effect. And while there's still a positive edge strategy, return risk, it's certainly degraded from what it was in the 60s, 70s, 80s, and even early 90s.
Wow. Yeah, you could feel it. It happens so fast. It kind of, there's definitely, I've traded, like I said, your book was one of the first books I've gotten. And I started learning about trading probably 1989, 90, and I started, actively trading 96 and part-time trading in 92, 93. And from that point on, again, the introduction of computers back then in the early 90s, I remember I was on AOL, and it was, it was the bulletin boards. It was, I was trading AOL. It was an interesting, the frontier. It was really the frontier of trading. And now, I can look back at this time and say, wow, how more volatile and the amount of news that comes out and everything that's involved. You talked about earlier, the one thing that caught my video, you said to have an edge in the market, and having being able to follow a trend is giving you that edge. Did the people that you've interviewed, who did you? I mean, you must have been really impressed with some of these traders. Of all those traders, who had the best edge, and could you kind of really narrow it down to some of the names that you really were impressed with?
Well, it's a little bit hard because there's a lot of them, but it's not that hard in terms of picking the best one. I mean, the best one just statistically, and in many other ways, would be Thorp, because he traded for so many years, probably 19 on the first fund and I think another dozen on the second fund, and compiled such an amazing record of very, very few down months and good returns, and also having being the first innovator for a lot of strategies that then became that many others ended up doing, like convertible arbitrage and statistical arbitrage, and so for all those reasons, an option trading, he took advantage of mispriced options because he had developed a mathematical formula to price them correctly before Black-Scholes was published.
Wow!
So I'd say that he was probably the most impressive in terms of the scope, and he's actually famous in the broader world. He's not famous for trading so much because he's had a low profile there, as he is for
Olympic swimming,
gambling world.
Oh.
Because he did the Beat the Dealer book, which was which sold a million plus copies. I don't know how many copies it sold, but couple of million. It became a very popular book on how to win a blackjack because again he was an innovator. He was the first person to kind of figure out how to bet to actually turn the negative edge of the house has in blackjack into a positive edge if you use certain card counting schemes. And he was the one who was instrumental in the casinos actually changing the way they operate, the multiple decks and the reshuffling, all that came about because of Thorp's book.
This guy is unstoppable. I mean, is he still alive today?
Yeah, he is.
Yes.
He's in his late 70s. Very, very vigorous still, sharp as can be. This is a guy. He's physically fit and all. So he's really. I think where anybody would like to be. In his 70s and so extraordinarily.
He sounds like he's a genius. I mean, he sounds like he's, he is.
I mean, he is. I mean, just to give you a flavor for it. Here's a guy who was a PhD for physics, who was writing his thesis, decided he didn't know enough math, in his opinion, to finish his thesis. So he started taking graduate courses in math and ended up then getting a PhD in math. Never bothered finishing his PhD, his thesis in physics, so technically he doesn't have the PhD, but he finished all the coursework for that before he got his PhD in math. So yes, I mean, that's the type of individual we're talking about. So,
wow. Amazing. I mean, you could tell that the guy just had a lot of knowledge. I was going to ask, my follow-up question was going to be, what personality characteristics would you attribute to him that other people could follow? Because there's no way I'm going to follow him on brain power.
Yeah. I don't think any of us can compete in him in brain power. He paid a lot of attention to bet size. I mean, I think that has relevance.
Risk.
There's a lot in the book, in that chapter about how to determine the correct bet size. And in fact, as I mentioned, the blackjack example, that's all about bet size. That gives you the interesting example that even a game with a losing edge can be turned into a positive edge if you bet more on the higher probability trades, or in that case, hands. But for a trader, what a trader can learn from that is that if you, instead of betting similar amounts or risking similar amounts every time you do a trade, if you risk more when you have a higher confidence level, and less when you have a lower confidence level, and vary the bet size that way, assuming you can distinguish better trades, better opportunities from worse opportunities, at least that your assessment of that has some value. If that's true, then you can, by varying the bet size, improve whatever your return risk is right now.
It's amazing. Have you written any books on gambling yet?
No, that's not my forte.
No. All right. But there is a direct correlation. I always say there is a direct correlation to poker and trading the markets, and we always stress, having that high probability. I use that term a lot on the station as what we call a high probability setup, and that's waiting for the market to give you the best signals all around, usually buying into a pullback and selling into strength. And it's almost, it's the correlation is so great. It's always a great analogy or, just a comparison between trading and waiting for the card count to get ready before you bet higher. I mean, do you play poker at all now that you've been in?
No, I haven't.
Blackjack?
Since my late teens.
Blackjack?
So, but no, I'm not. Actually, I'm not. I'm just not a. To play it. To play, actually, if you eat now the way casinos operate, even if you play correctly, you still have probably a tiny small losing edge, or maybe if you're really perfect at it, you might be equal to the casino. But I'm not interested in doing that. I just don't. Gambling doesn't appeal to me. If I was going to take the time to do anything, like that, I'd rather do it. I'd rather spend more time trading the market.
Yeah. Well, that was one of my questions too. I was going to say, because of you're saying if you could apply, your certain techniques that we're going to call it the Thorp technique to both, what would give you the best risk reward return and stuff. Do you think today's markets are hard? That the traders you interviewed back in the 90s. Have you kept in touch with them? How do you think they're doing in today's market? Is it that'd be an interesting follow-up, because it seems like the markets are much different.
I haven't kept in touch with them really. I haven't. So, I know that some obviously, continued on to do very, very well, like Paul Tudor Jones and Bruce Kovner and others, Drucker Miller, et cetera. And I was just retired, and a couple of others that I know ended up losing back a good portion of what they had made. So it really did vary, from what I know peripherally. But I didn't do any review and go back and do a postscript analysis. I can't speak comprehensively. From what I know, some did continue to do extremely well, and some retired, and a couple that I know of gave back, significant amounts.
I don't know where that is. Oh, sorry, there. So we got an email coming in for you, and hold on, I'm going to bring it up there. Let me just get that email.
Sure.
Another question I was going to ask you. No, I don't see it, Brian. Where are you from, Jack?
Where? Well, I'm from the age of 4. I grew up in Brooklyn from the age of 4. I actually was born in Belgium, and lived in the New York area, for most of my life.
Okay, let me.
As I do now.
Let me get this up here. Brian, where is that? He's printed it out, so you never have anything. So, who are some of the people if there is an interview person out there that you still haven't gotten to, is there anybody out there that you would love to interview?
Well, yeah, the one person that I never interviewed that is, like I say, besides, who may even have a better record than Thorp is Jim Simons, who's now retired of Renaissance. So, another mathematician, by the way. Very secretive, I would have. He was somebody I tried a couple of times to get to agree to, and one time I did get him to think about it for a couple of weeks, but that's as close as I got. So he's one that I would say is a great name that I would certainly belong in my books but he's never agreed to it.
All right, you think it's that's. I guess when you open up like that, if you have something good going on, it's hard to open up, like you said. eventually your style and system might not work.
Although, having said that, I mean, I did interview some arbitrator, like someone else who's, arbitrators who were very secretive but still agreed to an interview, and I was able to get, worthwhile material out of that interview. And someone like a D. Shaw, who was, extremely secretive, but yet agreed to do the interview.
Oh, that's good. A question coming in from a listener, Big Wave Rider. Jack has interviewed very famous and profitable traders. Some of them are still trading and some are not. Some of them have predicted the market crash of '87, but volatility has changed a lot since the top in 2007. My question is, are those traders still as profitable as they were back in the 90s or early 2000? Have any of those traders been wiped out since the crash of '08? I don't know if you...
we kind of answered.
Yeah.
No, and I as far as I know from for this book, obviously, it's not, for this book, obviously, traders did fine in '08. From the older ones, I don't really know. I can't answer because I haven't kept up. So I don't know what they all did until 2008 forward.
How do you see them? I mean,
I would suspect not.
Oh, well, again, just to touch base, we have, I was toying with your name, Jack, if it was Schwager or Swagger.
No, it rhymes with way, Schwager.
Schwager. So we have Jack Schwager, of course, the famous author from Market Wizards, New Market Wizards, and now Hedge Fund Wizards, Market Wizards. Just went on sale.
That's right.
Again, one of the first books I've ever bought, and the book that I actually held on to throughout my total trading career. There's not many good books out there. His book is up there with the Darvis book, and there's great books out there. I love that you're on the show, and I'm getting to talk to you, Jack. I really appreciate it. I just have a couple more questions, like
sure.
Something like off topic. I always have to try to get to know a person a little bit better. You seem very involved in the markets these days. What do you do to get your mind off the markets? What do you do for spare time, free time, playtime?
Well, I always do something physical. I used to, for most of my life, I was a runner, but because of an ankle injury the last couple of years, I've been just doing quick walks. So I do that every day if I'm not doing something else. The thing I would love to do if I lived in a different area, and I get to do, usually once a year, but I didn't this past year, is cross-country skiing. Mm-hmm. But I like outdoor stuff, like cross-country skiing, hiking, that type of stuff.
Well, nice. What was the other question I had? What do you see about today's markets? And what's playing out in Greece and Europe and the Eurozone? And I know that you're an author and you deal with the markets a lot. And I kind of asked this person because everyone has an opinion. Do you have an opinion on this?
Yeah.
And how it might play out?
I have a general framework that I've been operating off of.
Great. I would love to hear it.
I've been operating off of it probably from 2000 on. But basically my image is, well, you go back to 2000. I remember actually saying these exact words almost 5-6 years ago, whatever, in a meeting, and I got similar questions. And I said, if you go back in history and look at different major market tops, and certainly 2000 was a major market top, they rarely last. I mean, it's almost never that there'll be like a 3, 4, 5, even 10-year thing. They tend to last well over 10 years, and often 20, and sometimes longer. I mean, look at Japan still going. So or gold. Let's say it doesn't have to be just equities like gold. Like gold peaked in the beginning of '80, and it didn't turn into a bull market until 20 years later. More than 20 years later. So these things take a long time. Once you get a really major top, it tends to last for a long time. So my impression was that any time you go to, top end the range of these things, in equities, that you'd run into trouble, and that's exactly what's been happening. And I would still operate from that framework, although now we're 12 years after, so I guess, at some point, you do get to the point where it's going to keep on going. And on the other side of the coin, and so the other side of the coin, though, is that if you get these steep plunges as we got, say, in 2007-8, we had, which maybe, we got a leg down. Maybe, let's say if the situation in Europe deteriorates further, which is entirely possible, and, we're getting some economic weakness, which can spread, and there's all sorts of things that we have without getting into it, the whole onrushing train coming in the U.S. about At the same time, tax cuts expiring, automatic spending cuts going on at the same time. But all of that, if that happens instantaneously, if it's not averted or if there's concern about it, that could lead to more of a sell-off. So there are conditions around that can give you, let's say, another type of deep sell-off. Not that I'm predicting that. I'm saying you can get that. Mm-hmm. And then I would look at exactly the opposite. I think we're dealing for very broad trading pattern. So if you get markets into a panic state again, then I'd be inclined to be buying on the assumption that, there's a broad range and we'll again go back up eventually. There's another factor that I don't discuss in this book, but I do discuss in my next book, and it's about how markets work. One of the many things I cover there is how long-term investors are much better off coming in after the markets have done poorly for a number of years. And where we were last year, at the end of last year, we were still in a spot where it was good to be a long-term investor. And so if we go down this year from a very long-term investment perspective, it would probably be good to be a buy and hold type positions for long-term investment. Mm-hmm. If we get another sell-off, being a scale-down buyer, I think would be really a good thing to do. So those are just some broad contextual types of things.
Do you have any levels that you look at? Like we're trading right now 13.
Yeah, I do. Right now we just had one leg down. I would say, often you get like three legs down, but mm-hmm. But I'd want to see at least another leg down. So I wouldn't say this is anywhere near enough. So I'd want to see another leg down of about equal size to what we've seen, and wherever that takes you, that'll probably, whether that's it or not, that'll probably be a spot where a general area where you would probably get some support to begin with. But it wouldn't be a bad spot if you're looking at a longer-term buying mode. And then there's the other aspect that money has to go somewhere, and mm-hmm. as various markets sell off, and there's the while we have deflationary pressures, there's also the fact that governments around the world really can't pay off their debts either.
Yeah.
And that does lead to a danger of some inflation somewhere down the road, and there would be concern about that. So everything's priced in terms of a currency. So I wouldn't expect things to go down too far simply because the alternative, the dollar itself, is not something that would inspire confidence. Well, or the euro or anything else for that matter, because it's like a race to who could weaken that currency the most.
I think that's very well said. Do you think there's ever going to be the return of the day trader? I mean, when you came out with your books, day trading was probably peaking, going into 2000.
Well, that's, the irony of that is the success of the day traders had nothing to do with day trading.
Yeah.
It had to do with the long-term bull market, which was almost unbroken,
mm-hmm.
and it is actually the perfect illustration of don't confuse brilliance with a bull market. And so you had a lot of day traders who thought they were really smart because what they were doing was buying, but they were just buying in a train that was going, one way. As soon as the train reversed direction, they all got wiped out.
Mm-hmm.
So it wasn't that day trading was particularly profitable. It was that you could buy and hold it just fine too. So it was it wasn't the day trading that made it profitable. It was the fact that the markets had a long, smooth trend.
Yeah, but now it seems like
to an excess.
Since 2008, we've had this fear of so many people losing money in their 401ks and their retirement funds and the banking collapse and all this has happened has caused so much. I always talk about my sister not willing to put money back, invest money. Do you think there's ever, when do we see?
Yeah, and to speak to that, I always think the guideline is if you're scared stiff to put money in the stock market
mm-hmm.
because of all the horrible things you're seeing, what everybody else is all the fear, that's the best time. That's the best time to invest.
It feels that way.
I forget whose quote or thing is Rothschild. It says, "Don't buy," and
until fear,
which probably dates back to the 19th century, but said, "Don't buy until you hear the roars of the cannon."
Oh.
So you want to buy when you really want to go long when everything is really terrible.
Yeah.
And that's not for a trade. That's for an investment. So if you're looking to position something like a 401k, you really want to do it when everybody's scared stiff to do it. That's the time to do it. Not when everybody's optimistic.
Wow, great! You have some great stuff to contribute to today's show. Jay, I want to leave you with one last question for all our traders out there. Most of the traders I talk to are, aspiring traders who are trying to, make a living or, kind of, take a more active part in their trade as they juggle two jobs, but eventually would love to do this full time. And I know it's probably one of the hardest, things that you can do. But with your experience and your knowledge and everything that you've gone through over the last, all the people you've interviewed, and you're in pulling within, and you talk about the edge. What edge? What would be the best advice or best strategy? I don't even call it a strategy, but what is something you could leave us with that the toughest question in the world that leave a new trader, given a little edge? What's the edge you could give us?
Well, the edge is going to be different for everybody.
Yeah.
So the most important thing to understand is it's not about trying to find the best thing, the best way of trading the markets. The best way of trading the markets is different for everybody else. It's sort of like, what is the best prescription for glasses? Well, it depends on your eyes. What's going to be a perfect prescription for somebody is going to make somebody else blind. And so if you're going to try to find something that's good for somebody else, it's not going to be a right fit. If you're naturally skeptical of technicals and you find some technical system that supposedly works, it'll never work for you because you don't believe in it. If you're naturally long-term or short-term or whatever, and you try trading the opposite, it's not going to work. So the first step for anybody who wants to be a trader is figure out what you're comfortable in, what you believe in, what seems right to you, what you have confidence in, and then if you can do that and have some confidence that you make money over time, then that's your edge.
Yeah.
But the edge is different for everybody.
It's having believing in your passion and sticking to your rules, and it doesn't really It all comes back to probably the most simple stuff in the world. It's just to be able to understanding your own personality type. I think Yeah,
you have to trade your own personality. That's probably one of the most important things that I say, and I probably say it in every book because it's critical.
Yeah. Well, Jack, unbelievable guest. Thank you so much for just giving me your time and let me interview you.
Sure.
I feel free to always check back. I always tell you, we're here at Day Trading Radio. We're big fans of you, and I hope you have a rest of a great week and a great weekend, and hopefully talk in the future.
Hey, appreciate it.
Thanks so much.
Take care.
I appreciate
Bye.
it. Thanks. Bye. And there we go. And that was Jack Schwager. Hedge Fund Market Wizards, his new book out. And of course, the author of the famous books, Market Wizards and New Market Wizards. And a great interview. I think it was great. I think it went good. I felt good with that. I appreciate it. Got a lot of information. I mean, the guy has so much knowledge in it. It kind of just it's spilling out. It spilled all over the radio. The knowledge he had. I'm glad I got it recorded because I had to go back and listen to it. We got to get this Van K. Thorp on our show, Ryan. This guy is unstoppable. So Schwager said undeniably the best trader he's ever had to deal with is Van K. What is it, Thorp, right? Let's do it. I'll give you his name. You give me his number. That was nice. Big shout out to everyone who listened. And, you can't go wrong getting that guy's book. I don't know. Brian, order me that book too. Put that I'm serious, on Amazon. I just have to get that. I never have time to do it. Let me stop the broadcast. Oh, is it Van K or Edward? I don't know. Someone posted Van K. I'm not sure if it was like I said, there was so much information that came out during that interview. It was very hard to write all my notes down. I just caught the Thorp part of it. Ed Thorp? Thorp? Someone knows. Thorp. All right, let me just lock in this this interview. I want to turn off the site for a second. It's going to lock in the interview. I want to come right back. Be right back.